There's a right way to be your own banker and a wrong way to be your own banker. And unfortunately, a lot of people think the wrong way. And one of the ways that you make the mistake is you think you can use your private banking system to pay all your household expenses, your living expenses, and just every expense that you have. A lot of times I hear this, hey, can I put all my income into the specially designed whole life and then just pay all my bills? No. In today's video, I want to break that down. I want to show you why you can't put all your money through your own private banking system and why you shouldn't be using it to pay all of your living expenses. It should be used to take back the banking functions in your life, which has nothing to do with paying your bills. The hard part about the infinite banking concept isn't in the context of what you need to do to be your own bank, it's in how you think about money. That's the most difficult part. But infinite banking simply just means changing one thing, and that's where your money goes first, and adding one step to what you're doing now. The rest is easy.
Well, I want to hear what you have to say about the elementary fundamentals of how this works. But, I had an insurance agent tell me just a few weeks ago that he takes every dime of income he brings in and runs it through an infinite banking policy first. Now, that was kind of weird to me. So I, for my own sake, would like to hear your answer about that. But you just get started and go because I know it's going to be great.
Yeah, I hear that a lot too, and I think it's a misconception because you would never take all of your income and move it into your own private banking system because the money that you spend on your expenses, that's going to still flow through a bank and you're still going to write checks, you're still going to set up bill pays. So your own private banking system should be for things like major purchases or investments, things that you normally would go to a bank for that you're going to take back the banking functions of those. And I guess that probably doesn't make a lot of sense. So let's keep this super simple. Actually, I'm going to come over here and I want to show you something because when we talk about this, I think the most important thing for people to understand is maybe the why. When we think about the infinite banking concept, the why would be you should be in control of your money. And if you keep giving your hard-earned dollars, your income to a traditional bank, you are not in control. And people are like, oh, no, I'm in control. Oh, really? I've talked to people, countless people, that have gone and deposited money in the bank, and then they want to take that money back, and the bank starts asking questions like, well, what do you need it for? That shouldn't matter. If you're in control of the money in your bank account, then the bank should never ask what you need your money back for. It is indeed your money, right? But it's really not. You see, a lot of people don't read the fine print when they fill the application out or do the checking account paperwork because you are giving the bank the ability to use your money, and the bank does a very good job of using your money to make more money. So let me just kind of preface that. Does a bank call you and ask, hey, can we lend your money, your deposit money on this car loan? They don't call you and ask that. They just lend your money. Matter of fact, we don't even think about that because we just look at it on a statement or we look at it on an online portal and hey, it shows we have our money, so we just assume we're good. But what are some of the problems with traditional banks? And I think this is what we really need to unpack because if you're going to be your own bank, there's got to be a reason. And again, controlling your money is one reason. Certainty around your money is another reason. Having liquidity. Now, I know in your bank account you have liquidity. You put money in, you can take that money back out. So we want to maintain that. And then also, we want your money to grow efficiently. Your money is not growing efficiently in the bank. Because in the bank doesn't want to pay you a lot of interest. Now, I know there's high yield savings accounts out there right now paying 3, maybe 4%, which by today's standard is actually pretty good. However, if the Fed drops interest rates tomorrow, your bank account a lot less interest. Not only that, almost every bank account you can ever have, and actually I think all of them, at the end of the year, you're going to get a little thing in the mail. You're going to get a 1099 INT. You're going to get a tax bill for the interest that the bank paid you. So let's just try to talk about changing that one thing. And that is simple. We take your income. You're still going to spend some of your money. And we're going to cover that in a second because that's what that agent said. They said run all of your income through your own private bank. But what I'm telling you is you're never going to run all your income through your own banking system because you're going to continually have to spend money. You're going to buy groceries, you're going to buy food, you're going to pay for things that just are normal living expenses. And that money, yes, it's gone forever, but we budget for that. The rest of the money is saving. Now, this is really important. Your savings should be your single most important thing. I mean, it's a law of wealth. The first law of wealth says you must keep 10% of what you make, which in other words means you pay yourself first. But that's not what we're taught to do. We are taught to go out, make money, trade our time for money. Then we're taught to deposit that money in somebody else's bank. And then what do? We pay our bills, we pay for our expenses, and then whatever's left is what we save. Backwards. You need to pay yourself first. You're the golden goose, okay? I should say the goose that lays the golden egg, but you are the one that makes the money. You are the main source of income, okay? So if you're removed, then there's nothing else. So why do you put yourself last? You need to be first. And when you do start saving money, this is where I'm going to tell you, we're going to change one thing, and that's where your money goes first. So let me first do this because I want to hit that question about what that agent said. But if we're talking about infinite banking, there's going to be a lot of people watching this, Christy, I assume, that have never heard about the infinite banking concept. So let me just take them through just a couple minutes, 3 to 5 minutes of explaining why should you change where your money goes first and what are you going to accomplish. Fair enough?
Mm-hmm.
All right.
Yeah.
So first off, your bank account where you have your money, what interest rate are they paying you? Is it 0? Because a lot of people earn 0. Maybe it's 1%, 2, 3, 4. So what if you could get a guaranteed interest rate by changing where your money goes? And you can't. So this account that we're going to talk about does pay you a guaranteed interest rate. It can be anywhere between 2 and 3.75. But here's the cool part about the guaranteed interest. It's contractually guaranteed and it never changes. So if you lock in a 3% guaranteed interest rate with this account, it's 3% for the rest of your life. Regardless of what's happening in the markets, regardless of what's happening at the Fed, you get 3%. But see, it gets better than that. You get a dividend every single year. So these companies, this account pays you a dividend. And if we take the guaranteed interest, which I said could be 2 to 3.75, and we add the dividend, your dividend crediting rate that you're going to earn, your gross rate is going to be 5.9 to 6.6%, depending on which company we use. Now, is that better than what you're earning on your bank account? Probably. But here it gets even better. In this account, your money is going to grow tax-free. Remember, I already mentioned your bank account, you get a 1099 INT, which means you got to pay tax on the interest. In this new account that we're changing where your savings goes to, you do not. It is a tax-free growth of the internal buildup. So whatever your money builds to, it's all tax-free. Now, you have to design and engineer this properly, and that's a kind of a funny thing. So let me just pause on that. Designing and engineering this account. Now, that design and engineer, the reason why a lot of people don't know about this, the reason why a lot of advisors or agents either don't know about this or don't want to talk about this to you is because it requires them to make a lot less money. Their compensation is reduced 60 to 90%, but through that specially designing of this account. But the tax-free part's pretty cool. Outside of that, it's protected against judgments and liens in most states. For example, I got a call from a client the other day and they were just asking, hey, the money in that account, and I don't know why they were asking this. Maybe they're, assuming a lawsuit's going to come in. Is my money protected in this account if I get sued? So I went online and I looked it up. They were in Florida. Yes, 100% protected from judgments and liens in that state. Now, every state's different, but in most states, it does offer those protections. Not only is it protected, it's private. Private meaning you never need to tell anybody about it. You don't need to report it to the government. You don't report it to the IRS. Whatever money you have in this account, growing with guaranteed interest plus dividends in a tax-free account is private. Okay? This is why the wealthiest families throughout history have used this because they like maintaining that privacy. And also, there's no volatility. It doesn't go up and down like the stock market. The interest rate doesn't change like your bank account can. It's no volatility and it's no restrictions. When you want your money, nobody's going to ask you what you're taking it for. You just take your money out. Within 36 hours, the money's back in your bank account where it came from or where you want it to go. So all these things are the reasons why we would want to change where our money goes. Plus, we all know there's another certain in life outside of taxes, and that is someday we are going to die. We all will die. And when we do, we want to leave our family or our beneficiaries in a better place. This account will do just that because it will pay out a death benefit. Now, after I told you all those things, how many of you listening to this want that account? Probably a lot of you, right? You're like, yeah, that's way better than what I'm getting in my bank account. And a lot of you are probably thinking, well, that other agent said, let's put all your money through that. And you're thinking, well, if all those things are true, why wouldn't I want all my money to go in there? Well, let me give you one reason around that. Number one, this account that I just told you is a specially designed and engineered whole life insurance policy. I know that's not what you were expecting to hear, but that is exactly what it is. And that is exactly what it does. So when you think about stuff, we always focus on what something is, but we should be focused on what does it do? What problem does it solve? And this account, this specially designed whole life, solves a lot of problems. But the insurance company issuing these accounts, these specially designed and engineered whole life policies, that insurance company will not allow you to put all your money in it. They wouldn't allow you to put 100% of your income into a policy. It's just not allowed. So how much could you put in? It's company by company, but let's just say 30 to 40% would be a good starting place. That's how much of your income could be put in. So when that person said that, like they wanted to put all their income in, that's just not possible. But it also wouldn't make sense because again, remember, if we're going to put our money into this account, we're going to use this money. This isn't a place where you're going to put your money and you're just going to leave it sit. Although you could, and you probably would be fine doing that. But what we want to do is we want to solve a problem. And everybody has a problem. Some of those problems are they have debts that they want to pay down. Another one of those problems, maybe they want to start a business and they need money for their business. Maybe they want to buy a new car and they need money to buy the new car, or the new tractor, whatever the major purchase is, they need the money to do that. Or maybe they just want to invest money. Maybe they want to buy real estate, invest in the stock market. Maybe they want to lend money out. Whatever it is, that's what I call the opportunity zone. So the infinite banking concept involves that change of one thing. And that change was where your savings goes first. And we're going to put it into this specially designed whole life. The second part is the process. We're going to add one step to what you do today. And this is what we're going to do. We're going to look at everything that you have, all of your opportunities. And if you have debts, we're going to start there. And let's just assume, I'm just going to make this as an example, somebody's got a Visa card, and let's just say they owe $10,000 on that Visa, and that Visa card is charging them 25%, and they're making $500 a month payments. Just an example, okay? That would be a problem because you're giving up 25% interest to the credit card company, plus $500 a month is leaving your family forever. So here's what we'd do. We would change where your savings goes first. We'd save up enough money in this account where you would have $10,000 or more. And then what we're going to do is we're going to take that $10,000 out of this account, but we're not going to take it as a withdrawal. We're going to take it as a loan. Now, I know that doesn't make sense right now, but I'm going to help it. I'm going to help you understand that. Why would we take a loan? Well, the insurance company that issued this whole life policy has a provision, a really cool one. They will allow you to borrow their money, the insurance company's money, their general account funds. They'll let you borrow their money anytime for any reason under a couple conditions. Number one, they are going to make sure that you have enough money, enough cash value in your policy to collateralize that loan. So if we're going to take $10,000 out as a loan from the insurance company, we need to have at least $10,000 to collateralize that loan because the insurance company wants to make sure that if you run off, then they've got that covered. But there's a second piece, and this is the really fun piece. That insurance company promised you a death benefit. So in this case, let's just say you had $1 million death benefit, okay? What the insurance company is actually doing is the insurance company is lending you part of your death benefit. In this scenario, that's $10,000, okay? So if you had $1 million death benefit and you took a loan from the insurance company's general fund of $10,000, you need to have at least 10 grand to collateralize it. But what they're doing is they're subtracting it from your death benefit. So the next day, if you were to pass, $990,000 would be paid out to your beneficiaries tax-free, not $1 million. So the insurance company is actually giving you part of your death benefit while you're living. Now, here's the downside. They charge interest on that. So I'm just going to use a hypothetical rate of 5%. The insurance company is going to charge you 5% to use that $10,000 of your death benefit. But here's the reason why you wouldn't want to use this money to do general expenses or general living expenses. If you took $10,000 and you went out and you blew it, you paid groceries, you went on a trip, I don't know, you just spent it frivolously. The insurance company is charging you 5% on that money. But they're charging you 5% on the money. The one thing that I left out, because you're not taking your money. If you had $10,000 in cash value in the account and you took $10,000 out, Christy, how much money would most people think is left? You started with 10 and you took 10,000 out.
You would think zero.
But it's not.
Right.
You have $10,000 still in your account. $10,000 earning guaranteed interest, $10,000 earning dividends, $10,000 growing tax-free with uninterrupted compounding interest because you didn't use your 10 grand. Remember, your 10 grand just collateralized the loan against your death benefit. So now that $10,000, if they charge you 5, let's just say your dividend crediting rate was 6, what are you doing? You're making a spread. How do banks make money? Well, you deposit money in the bank pays you interest on your money. Let's just call it 2%. Then when you need to buy something, you go back to that bank and you borrow money, let's say a car loan. Does the bank charge you more or less than what they pay you in interest? So if they paid you 2, do you think you could go to that same bank and get a loan for less than 2%?
No.
The bank would lose money. The bank would go out of business. They're going to charge you like 5%. They're going to charge you an arbitrage or a spread. They pay you 2 and they charge you 5. So in this scenario, let's kind of unpack that. If you're going to be your own banker, well, wouldn't you want to do exactly what a bank does? You would. And are you not doing that? If you were earning 6% in a dividend crediting rate and the insurance company was charging you 5, you would be making hypothetically a 1% spread, would you not?
Right.
Cool. But you see, it gets way better than that. I just wanted you to understand how this works. Now, given that, if 6 minus 5, you would still say, well, why wouldn't I put all my money in and pay all my expenses? The reason is there's just a better way. Your money has to work for you, and it needs to work harder for you than just spending that money and making a 1 or 0.5% spread. That's boring. So let's go back over to this credit card. We took $10K out of the policy. The insurance company gave us $10K of our death benefit. We use that $10K. We come over here and we pay off this Visa. Okay? You following me? We paid off the Visa. I'm going to grab my calculator because I want to show you something really cool here in just 1 second. So we pay off the Visa, but now what we're going to do is we're going to take that same $500 a month that you used to pay to Visa, and we're going to take that $500, we're going to deposit it in the bank account, and then we're going to sweep it into the policy. And we do all that for our clients, but we're going to take the $500 that you recaptured because you no longer owe it to Visa, and we're going to put it back into your policy, which is your private banking system. Now, here's what happens when you do that, and this is really cool. So every time you do that, we'll just use $500. That would be $6,000 a year. When you put the $500 back in the policy, you have exactly $500 because the insurance company only charges you interest on the loan 1 time per year. So let's just do the math, right? $10,000. If you were earning, or the insurance company was charging you 5%, they'd be charging you $500 a year in interest, okay? Simple interest. Now, if we recaptured this $500 that we used to give to Visa, and we just changed where it went, we put it back into the policy as a loan repayment, we didn't lose any liquidity. You still kept $500 every month, okay? Before you gave it away, and now you keep it. So you're already putting yourself in control of your money. But you're doing another thing. Every month, $500 is being reduced from the loan that the insurance company is charging interest. So in a course of 1 year, you have repaid the insurance company $6,000, which means the insurance company is now only charging you 5% on $4,000. So let's just do that math. 4,000 times 5% is $200. Do you want to pay the insurance company $500 in interest, or do you want to pay them $200 in interest? Well, I think all of you only want to pay them $200 in interest. But let's just do some math. If you did $200 divided into the original loan of $10,000, because in your mind, you're thinking, okay, in my mind, I'm paying 5%, but you're really not. If you did exactly this, you're not paying 5% anymore. Now the math is 2%. All I did is I took $200 and I divided it into $10,000. That's 2%. Before it was 5, but you paid the balance down. You lost no liquidity. You see, this is why you want to be an honest banker. But this is also why you don't want to use it for living expenses. So let's go back to that original question from the agent. I first wanted to explain the infinite banking concept, which is this circle. Now, we just showed this with paying off debt. Great. But what else could you do that for? Well, I don't know. Let's just say you had a business and you wanted to start creating content, which means you needed to buy new computers and cameras and maybe some lights. And that was going to cost some money. Well, instead of going and putting it on a credit card or borrowing the money from the bank, what if you capitalized your own banking system? What if you changed where the savings went and you used the money from your banking system to finance that loan to your company? And then your company made payments just like they would on a credit card or just like they would on a business loan from a bank. You make the same payment back to yourself like I just explained. But now you lose no money. You don't give up any money like you would with a bank or with a credit card. You keep all of it and you control the spread. Because if you were earning 6 and you were paying 5, you'd make a 1% spread hypothetically. But if you were earning 6 and only paying 2 after 1 year, see what happened? Now you're making a 4% spread. And if you did that for another year, another year, another year, your spread just keeps going up. You're in control of that. So by being your own bank, you are number one, making more on your money in a tax efficient account, but you're also getting yourself the ability to take all the control that you give up. You give up all that control to a bank and you pay the bank all that interest. Pay yourself the interest. And just think about how your life would be different if you made interest payments on all your debts, just like you do today. But let's say every one of those checks you write to their bank now gets written to your bank. You'd have a lot more money, a lot more. And if you just did this for debt, you're not just paying off debt. You're also building wealth at the same time. Because remember, in that scenario, if you had 10 grand over here, that 10 grand continued earning interest and dividends and never stopped earning, even when you used the money. That should be an aha moment for a lot of people, because that right there means that you can make money twice on every single dollar you earn. So when you make a dollar, imagine that that dollar can go work for you 2 times. Once inside the policy earning compounding interest. Twice out there working for you in this opportunity zone, paying off debt, financing your business, investing, whatever you want to do with it. That's why they call it infinite. It can be used for anything. But here's the thing. I would never want to take loans from the policy, be charged interest by the insurance company. Even though I'm making a spread, I'm still paying interest. That interest is still leaving my family forever. And then using the money over here for living expenses, which do not allow you to do any of this recapture. So now, all of a sudden, that ability to move the money back into your bank doesn't exist because it's just being wasted. It's just being spent. So it wouldn't really benefit you. And well, it would a little bit. It'd be better than what you're doing now, but it wouldn't really put you in a much better place. It would just create complexity in your life. That's all it would do. It would be adding an additional step to really make a very small amount extra. So that's why I disagree with what that agent said. And that's why I disagree with what a lot of them say, because a lot of them say, oh, put money in the policy, use it to pay your bills. That's an easy sales process, isn't it? They're just trying to sell you a policy. Even though they're making a lot less on that policy if they design it properly, they're still trying to sell you something because they're not solving a problem for you. They're just selling you a policy. Yes, you're getting a death benefit, but you're really not allowing your money to work in a capacity that really benefits you. Whereas if you recapture it and you do the full circle, that's all this is, a full circle, you then really, really start to build wealth. So that's why I disagree with that.
You know, that is such good information. And what I was thinking while you were talking there on the end is your implementation team is unbelievable. And when you have a client, for example, if I send you over a client, which that happens often because I don't personally write these infinite banking concept policies myself. But when I send them over, I've never had a negative result or any feedback come back saying, you know, well, they got me set up in this, but I feel like they just sold me a policy. And with you saying that and showing me why that wouldn't be of any benefit, just verifies what I already know is that you know what you're talking about, first off, and you're not trying to sell a policy. This is about getting the American people that are uninformed about how their money should be working for them, and you're educating them. And then when you guys set up these policies, when this happens, you're literally, you have an implementation team that actually shows them what they need to be doing with the money that they have put into that policy. And I think that that's super great. So I knew you were the one to ask that question. But yeah, I think that's such good information. And, you know, when you're talking about, it makes so much sense because when you're talking about putting all of your income into these policies and then pulling back out for your expenses, I really don't even see how that could work because you have expenses every day and you wouldn't be wanting to wait for that 2 or 3 day transfer into your checking account until you got the monies to pay your bills. It's the way I looked at it when that was mentioned to me. I just think that you do a wonderful job. I appreciate that information. And I'm going to have one more question for you. And you may want to save this for another video, even, but I was asked this last night. What would be the benefit of a preacher actually having some kind of policy or that the church has on him as the insured? How does that even make sense?
That makes perfect sense. And we do a ton of work like that. So
Okay.
the church is a nonprofit,
Mhm.
and here's the thing, the nonprofit comes up with budget line items. And one of the big things the church always is looking to do is raise money, right? Through tithing and different, charitable donations that come in. They're trying to raise money to do more, to build the church, to, kind of just help and serve more people. Well, think of it this way. Let's say the church changes one thing. So the church has money in a bank account, right? And that bank account is not really serving them. It serves a purpose of we put money in and then we use that money to go out there and do our service and do what we do, to serve the Lord. But here's the thing. Imagine if they changed where some of that money went. Instead of putting it in the bank, they put it into a policy. Now, the church cannot do this because it's an entity, but the church has an insurable interest in that pastor. So if something should ever happen to that pastor, the church would be at a loss. They would have to find a new pastor. They'd have to go out there and recruit, spend money to do this. So that gives the church an insurable interest in the pastor. So what the church could do is go and make a deal with the pastor or tell the pastor, hey, listen, we're going to divert some of the church's money. We're going to move it over into a whole life insurance policy designed and engineered for banking because we want to use this money to grow. But we need a body to insure. And being that you're our pastor, being that we have an insurable interest in you, we would like you to be that insured person. And for that, what we're going to do as a church is we're going to give you a fully paid up death benefit for your family, bought and paid for by the church. So the pastor wins because the pastor now has life insurance on their life that then serves or protects their family. But the church also can use the capital going into this, just like we explained, okay? But the church can also use the death benefit when the pastor passes. So if the pastor passes away, one thing is going to happen. The church is going to file the paperwork, okay? And a death benefit is going to be paid to that pastor's family, his beneficiaries, his or her beneficiaries. But the remaining amount of the death benefit is going to be paid tax-free to the church. So now all of a sudden, let's just use, let's say it was 100 grand. I'll use simple math. Let's say it was $100,000 that the church put into that policy, and they got to use that 100 grand while they were operating. But then that pastor passes. The church might now get a check for $2 million tax-free. How much work can the church do if it has an extra $2 million of tax-free money? And the pastor certainly wants the church to be in a better place should something happen, but the pastor's family is also in a better place. So we do tons of this work. And
Wow.
a lot of times when you explain this to a church, the church will take this and go out to, everybody that benefits from the church and say, hey, listen, here's what we're doing. And then what they'll see is they'll see additional donations coming in, additional tithing coming in to basically fund the policy because they see the purpose of this. They see the benefit of this. We've done a ton of that work.
That is good information. So I have a few pastors I'll be talking to about this. I had an elder ask me last night. He said, what happens when the minister leaves?
Nothing really. So the church is the owner. In
Right.
ownership comes control. So if that person were to leave and just go on to another opportunity, that doesn't change anything. The church could keep that beneficiary exactly the same, but the church still owns and operates that, regardless of whether the pastor's still there or not. They still control that money, and they will continue to control it. And same thing as I just said, when the pastor passes, that death benefit is still going to be paid back to the church. So nothing changes.
Wow. Okay. That is really super information. So now you've just filled my head with all kinds of ideas. I just think, again, the ministers that have been coming to me about this, they had no idea this was available. And they're actually the ones I'm speaking of now are going to be having an elders meeting talking about this and, what they need to do to move forward. So such good information. Thank you again, Chris. I'm going to let you go today so that you can get about your day, but I just appreciate you. And I can't wait for us to do another video where you're going to teach us even more about, questions that I get every day. And it's just wonderful to have a resource like you to go to. So thank you.